if we've got some investors, which I can see that we do, we're just going to touch on some of the things just to help to make sure that you're prepared for tax time. And there are also some big changes that they've made, or some reasonably big changes that they've made for investors that we want to make sure that you're aware of. So this is where my poll was supposed to go. I put the poll time last time, but I'll just launch this one here. So I just want to get an idea and an understanding of how many investors that we have here, and what you're invested in. I think you can only select one option, I think. So we'll just see how you go. Perhaps if you've got multiple things, you can select other. But if you give us an idea of what type of investments you have. Okay, we've got some people who've got shares. Some have got properties, other. I just wonder if that's people with multiple investments. Just waiting on a few more. Okay, so we've got people who are invested, which is really cool. That means that this section is going to be relevant to everyone. And even if you're looking to invest, I think it's probably just worth noting some of the things that you need to be mindful of as well. So I might, not everyone's responded, but I might just close that so we can keep pushing forward. So we had 33% in shares, 33, a third in property, and a third in other as well. So cool. All right. So investors, this is what you need to be thinking about. So capital gains. So just a reminder that you only get that 50% deduction on your discount on capital gains tax if you hold it for more than 12 months. So this is particular, I guess, a highlight for anyone who is property flipping. So if you're flipping property, buying and selling property very quickly, then you're going to pay more tax than you would otherwise would. But obviously then you've got more holding costs as well. Bitcoin. So if you were one of those who purchased Bitcoin, be mindful that if you were buying and selling, there's effectively two ways that the ATO would consider it. They would consider either trading. So if you're trading it, then all of the income that you make, all the sales you make would be classed as income as opposed to capital gains. Again, the downside of that is that you don't get the discount, and then you can't offset your capital losses against those that income as well. And then those who have shares and managed funds. So if you've got managed funds, they send out a statement, which is pretty cool. So you don't have to work out what those figures are. The only downside to that is normally it takes a few months for those statements to come out for them to balance the figures. So it means that if we do have, so if you're someone who's recently invested into managed funds, or even someone who already was but forgets, we need some time for those statements to come in order for us to do your taxes. Again, often that information is uploaded to the ATO, so we'll get that pre-fill information. If you've got a dividend reinvestment, now I can see, knowing some of the clients that were here with us just now, with the dividend reinvestment, that's actually makes things a bit tricky because effectively you keep purchasing shares. So every time those dividends reinvest, you're buying more shares. So the difficulty there is that when you go to sell those shares, it's often hard for us to calculate the capital gains because you've been slowly acquiring shares. So I would definitely highlight and recommend to anyone who's got shares and they've got dividend reinvestment that they start up a spreadsheet to track every time the dividends reinvested, unless they're using a particular platform that tracks that for them. But it becomes an absolute nightmare if we don't have that information, and then we've got to go back through years worth of documents and try to calculate those numbers, which becomes very, very tricky, and obviously best if you can do it progressively as time goes on. So if that's you, whilst it might not be applicable and you think you're going to hold your shares for a long time, save yourself the headache in the future by just capturing that information now. So it's just a case of having that spreadsheet and keeping it going. If you're not sure what to do or you can't be bothered, that's why we're here. So I'm more than happy for you to leave it for us. I say that I'll probably make Rachel do it, but yeah, so happy for us to assist you in preparing that. So bank interest is another one as well. So as an investor, if you've got money sitting in the bank account, we have sometimes clients forget about that. So make sure you pick that one up as well. I just want to touch on, sorry, I should actually come back to just with the shares as well. This one, again, is a difficult one to track. So make sure if you're buying and selling shares that you're recording and saving down that information. I know that some of the people here have started investing for the first time. So just check the platform that you're on and start to suss out what sort of statements, I guess, that you can produce out of that. Comsec's pretty good. Some of those bigger platforms are pretty good with the reports that they produce. But you just need to be keeping all the buy documents and all the sell documents so that we can calculate the capital gains that you have there. And we need to record any brokerage fees that you're paying as well, and ideally keep a running spreadsheet. And normally, again, for a client, if they haven't, even if they haven't sold anything, if they're buying stuff, we like for you to provide that information to us so that we can keep a track of it for you. So if you ever go to sell it, then we've got all those that information on hand. Okay, so property investing. So again, we've got the rental collection form, which we've put there as a handout. So you can download it from the webinar, but it is also available on our website as well. So if you go to hannansfinance.com.au, it's on the front page there and you can download it. I'm going to click on it now, and if technology is going to be my friend, it's going to open for me. So with, and it's not working, but that's okay. So so with that one there, again, if you just access that, it's, to be honest, it's the same as the one. So if you've completed this in previous years, then it's the same one there. It just effectively prompts you to think about even things like percentage ownership. Like that's a really big one because we need to make sure that we're treating that appropriately and we've got those appropriate details. The ones that I really want to highlight to everyone is things that are often overlooked. So lender's mortgage insurance. So the buying costs, sometimes people don't realize what those buying costs are. So highly recommend that if you have purchased a new property, make sure that you bring in all the documents to us so that we can just check everything and make sure that you're not missing any possible deductions. Sometimes lender's mortgage insurance can be about $8,000, $12,000, it can be quite substantial, and so a significant. And so again, if you're claiming about 30% on $12,000, it's $4,000 worth of tax back to you. So it's a significant amount of money. So if that is you, just make sure that you're aware of that and you're maintaining those documents. Depreciation is another big one. We had a client come back to us that moved away. And we hadn't seen them in about 4 or 5 years, and they've recently come knocking on our door and said, you know, we know we've moved away, but can we still come back to you, because we realised that our accountant hadn't been claiming depreciation, and it worked out to be a couple of grand worth of tax, a tax refund that they were missing out on. So fortunate for us, and this is a bit of a tip. So if there is something that's missed on your tax return, we can go back 2 years. But that's all. So if there's something beyond that, unfortunately, we cannot go beyond that generally. You can lodge an appeal, and potentially if that's approved, then we can look to make amendments beyond that. But generally we say it's 2 years that you've got to make any amendments. And actually that works in a good way as well. Generally the ATO, unless they suspect fraud or anything, that they won't go back beyond the 2 years unless they specifically suspect something. So which is kind of good news. So these are the key changes. So for 2018 financial year, so this is only brand new. It's only come in as a result of the May budget last year, that you can no longer claim travel to property. That's a really big one. I've got some clients who've got property interstate, and that used to amount to quite a substantial amount. Some clients who are overseas and they used to claim that, and they can no longer claim those trips anymore. And I think that's because the ATO felt like a lot of people were abusing that, and so they've unfortunately canned it. You can no longer claim depreciation on second-hand residential properties that are purchased after the budget last year. So if you already had a property that was purchased second-hand and you've got a depreciation schedule, all good. But if you bought a property anytime since May last year and it was a used property, then you won't be able to claim the depreciation on things like the air conditioning, the curtains, the appliances like the washing machine and dishwasher and all those sorts of things, unless you actually buy it. So if you go and then replace the dishwasher, you can claim it. If you replace the aircon, you can claim it, but you can't claim it on secondhand residential properties. Again, I think this is potentially an area of abuse, unfortunately, for a lot of people, because a lot of people would have depreciation schedule done up and it would be a secondhand item, and they'll be claiming $3,000 for an air conditioning unit that was probably only worth, you know, $500. So again, the ATO decided that they were going to stop that completely because they felt that people were abusing it. So so this one here, I actually put this, found this online. So the Money Mag said that according to our analysis, over the first 5 years of ownership, the new law will result in an average loss of around $4,236 in depreciation deductions each year. So again, using our 30% rule, we're roughly looking at about $1,200 per year that will make a difference to those people. So quite a substantial amount. So quite unfortunate for any people looking to invest or have recently purchased a secondhand residential property. But yeah, significant change there for this year. So question time. So I don't know if anyone has any questions with regards to the investment. I can't see anything. If not, all good. I think we can keep moving forward. So we're now going into the final